All right, so inversion fair value gaps checklist questions. Okay, no, that's a mouthful. So I have individual slides on each of these bullet points. So you're gonna see that in the my face cam a little bit. You're gonna see that in the next following slide. So I'm gonna go over each of these individually. So this is a great thing to look at when you're taking inversion. Okay, asking yourself these questions is going to make you take better inversions. Okay, and it's going to cause you to see the signature and price much better. So first one, is there a liquidity sweep? If not a liquidity sweep, is it an SMT or is it in the overall direction of higher time frame bias? So there might not be a sweep, but there might be equal highs above, which means you still might be able to take it if you know it's equal highs above. The sweep is going to be better, but I still have seen them work with like obvious equal highs above. All right. Was the liquidity sweep fast or slow? Was there a lot of speed momentum going above the inversion? The best inversions are always going to have a fast liquidity sweep to the. So if I'm taking a bullish inversion, the best liquidity sweeps are always going to be a fast down move as well as a fast up move. A lot of people underestimate how fast the down move has to be. If the down move is fast, the up move is fast. It's going to be better than if the down move was kind of slow and then the up move was kind of like slower. Maybe it was fast, but it's always better when the down moves fast too because it's a lot of selling, and when we go back above those algorithms selling right away, they'll just immediately reverse position. So the speed is important too, and I'll go over more of this. If there's no liquidity sweep, are we delivering from another fair value gap, either from a lower time frame or a higher time frame one? Okay. If there's no liquidity sweep, you want to see us delivering from a fair value gap. If we're not delivering from anywhere else other than a fair value gap, it's probably not going to be a good inversion. The other one is the inversion relatively newer? Okay, if it's really far away and not easily spottable, I don't really like it. If it's the older it gets, the more momentum I want to see going back through it later. If it's really old and we get really slow momentum going back to it later, it probably does not matter. Is the fair value gap a singular fair value gap? Okay, if it's not, you want to go to the highest time frame where it's going to turn into a singular fair value gap. So if there's two fair value gaps in a row on the 1 minute, go to the 2 or 3 minutes, see if it's a singular fair value gap. And if there's no time frame where it's a singular fair value gap, okay, let's say there's two fair value gaps in a row on the 1 minute time frame, and there's no fair value gap on the 2, 3, 4, 5, whatever. Wait till the second one breaks as long as the RR is not bad. And I'll go over an example of this as well. I can actually go over an example of this right now. So what I mean by that is here, okay? Here, if I go to the 1 minute from earlier, there was multiple fair value gaps here. Okay, there's multiple fair value gaps. So there's one here, one here, one here. And what happens is if you're basing this trade off the 1 minute time frame because you don't understand liquidity, obviously, if you do understand liquidity, you would have understood these should all be broken. But if you don't understand liquidity, you have to wait for the last one to break. Let's say go to the higher time frame and there's no fair value gap here. Well, I had to go to the highest time frame and wait for the last one to break, and that's your play. And I kind of mentioned, I say, as long as it's the RR isn't bad. But if we go back, this RR is horrible because the RR would be the stop would be below the last for inverse fair value gap. So if these weren't here, then it would be below this. Okay, but these are here, so it had to be here. So this actually is not a good play from a 1 minute standpoint. Okay. If I can find, let me see if I can find one more example. So, right, I know there's one earlier, I think. Right here, this is fine. So here we have two consecutive ones. Let's say this one is the last one to be inversed. Let's say if I go in the 2 minute, let's say there's no fair value gap here. And I actually don't think there was. Let me check. So, okay, there is no fair value gap in the 2 minute. So we see in this situation, there's two fair value gaps. We have to wait for the last one to break, and this one would be good risk reward still. Your risk would it would be a little more higher than this one. It would have to be above this last FVG. So This risk reward, if we close onto this, would not be bad versus the other one I just showed you would be horrible. But sometimes if you do 2 fair value gaps, you can still take them as long as the 2 fair value gaps are relatively close to each other and the risk reward still isn't horrible. Okay. Are we inside of kill zone? That's very important. You never want to trade these outside of kill zones. Okay, just trust me. They're just, you don't want to trade at midnight. There's just no action. You do not want to trade anything at midnight. I don't care what you're trading or what model you're trading. Did we hit the internal high? If we did, are you still confident in bias? All right. So I already talked about that before. If we hit an internal high, are you still confident in bias? So if I go to the chart, we have this inversion here. So let's say this wicked above. So here's the internal high. It's the internal high before the fair value gap was created. Let's say price wicked above this. All right. So let's say price wicked above that. If I was still confident, maybe there's perfect equal highs up here, I might still enter this. Most of the time I don't, but if I'm really confident, I will still enter this. Okay. So that's what I mean by that question, by that thing. So let's get into all the individual bullet points. So again, it's all this is going to be is the individual bullet points of all these. All right. So first one, is there a liquidity sweep? Okay. And again, a liquidity sweep could be anything like if we go above or below equal highs, data highs, previous day high, refer to my liquidity pool slide. Okay. Use that for your liquidity. Okay. It's not just going to be random saying high or low. It has to be something that I said in the liquidity pool slide. So I'm always looking for some sort of liquidity sweep. Okay. And if not, I'm obviously looking for a higher time frame fair value gap delivery, which I'll go over. But liquidity sweeps are hindsight for how I trade. So I don't know, like, I wait for the reaction at a higher low. I don't try to predict if we're going to go under or not. So what I mean by that is I'm not trying to predict if we're going to go under this low or high. Like, I don't know if we're going to displace under this or not. I wait. And then once I see this, and then I see this inverse, and I see, okay, in hindsight, we barely displace under this. I now know this is a good inversion. But typically in live time, sometimes you don't know if we're going to displace under or not. And you know if we don't displace under it and we inverse this, then you know this is probably going to be a good long because, again, we barely displace under this, all right? And the other thing is I like the speed that we go under here. We kind of just, it's a one candle sweep, which is nice there. If I notice a lack of displacement below low and there's an inversion activates, I know it's probably a good inversion because of how we reacted to the liquidity pool. So exactly what I just talked about. And again, the only time I don't actually need a liquidity sweep is if there's an SMT. Okay, so there's an SMT video, watch that. So that's the only time I don't really need a liquidity sweep. And usually one of the indexes does sweep, so technically it still is a liquidity sweep, but you get what I mean. So in this example right here, I don't predict us to bounce here. I don't know that we're going to barely displace below this low. What I know is in hindsight, we barely displace below this low, and then we inverse this for a rally gap. So I now see this as a good trade setup because I see that price barely displaced below this low, and I see that we inverse this. Okay, it would definitely be a different story if we really went down here and then came back up here because this would just be really old now at that point, and I have a different criteria for taking old fair value gaps. So it's a good fair value gap because we do not displace below low, and then we quickly, in one candle, we just come up, violate it here, and then just we take off to the internal high. And these are actually data highs from my one setup for life video. So in this example, there's no liquidity sweep. Okay, we don't sweep this low here. However, this is the 5-minute time frame. As you can see here, this is the 15-minute time frame. As you can see here, the 15-minute body holds this very algorithmically. And what happens is this is still a valid IFEG because even though there's no liquidity sweep, we're still bouncing from a higher time frame for a value gap. So this is still a valid trade setup. Does that make sense? So we don't need a liquidity sweep if we're holding this, okay? And again, usually in this situation, you'd probably know the bias is bullish. There's probably some intermediate term high or equal highs above. But in this situation, you don't need a liquidity sweep because we're delivering off of a higher time frame, 15-minute fair value gap, if that makes sense. Okay. In this example, we have a bullish SMT. Okay, you can see NQ took the low. Yes, did not. So in this leg, there's no liquidity sweep, but this still is accurate to take if you were confident the bias is bullish. Again, I know we hit internal liquidity here, so technically it wouldn't fit what I do, but let's say I was very confident the bias is bullish, I'd still maybe long this. The other thing is there technically is a liquidity sweep here. I'm just talking about the higher time frame. Like we don't need a higher time frame liquidity sweep here. I mean, we don't really need this either. This does not have to sweep here. If we got an inversion without the sweep, I still would have taken it because the SMT, if that makes sense. All right. So you can just see if I move my picture a little bit. Hope you guys could have seen the last side. Again, you can just see like you need a sweep or you need a delivery off of a fair value gap of some sort. All right. So next one, was the liquidity sweep fast or slow? Was there a lot of speed and momentum going above the inversion? Okay. The best inversions always have very quick displacement, usually 1 or 2 candles displaced below and above. If we've, like I said, if we have instant 2 candles, below, then above a high again, and we rocket quickly through the inversion, that means it's probably going to be a high probability setup. So I'll show you some examples, but the setup can also just be as good if we respect the fair value gap to the other side and break it. So we do not have to, I'll show you a few different examples of this, but this bullet point is only applicable if we have a lot of momentum going through the fair value gap that we just respected. And I'll show you an example of this. So in this example, this is a very fast sweep. You can see there's obviously only 2 candles that sweep this, so it's very fast. So on the lower time frame, I know that any lower time frame setup here, we get would be a really good inversion because of how fast we sweep liquidity. And I don't know how fast we're going to sweep liquidity until I see this, okay? This is hindsight, but then this is where I start looking for the setup in this kind of area right here. Okay. So again, you can see here, this is more of a slow sweep. Okay. In this price example, we sweep liquidity and then the price just dies. So you can see this is more of a slow sweep. So any inversion we got here, I would not like. And then here, we don't even get an inversion set up here, which is the nice thing, but any inversion setup we got here, I probably would not take, okay, because it's really bad. And then you can see right here, we sweep south side. It's a 2 candle sweep, 1, 2, and then 3 back up. And then this would be an inversion setup. And this is actually invalid for me because we hit the internal high. But let's say, again, I was very confident in the bias. Then maybe I would take this. Okay, maybe I would take this bullish fair value gap instead. I would probably wait for the retracement on this one because, honestly, this one is just too risky to long up here. I mean, not bad. You're still kind of getting in high, but I'd probably wait for the retracement on this one. But again, 2 candle sweep here, very fast displacement back up. These setups are always very good. I call these like the V-shape recovery setups. Okay, so makes it very low probability here, and then this is one is better probability. So this is what I was talking about the fair value gap being respected as first. The only time I like a fair value gap being respected and then taking it as an inversion, because you're probably wondering, like, technically this would be our internal high and we kind of hit it. So it would make the setup invalid, but it's still technically not invalid to me. And the reason is because this sweep here and then this being respected, and it's mainly the momentum back through the fair value gap that was respected. This is the thing that makes the difference for me taking a setup that, okay, this fair value gap is respected to the downside. There's a lot of momentum back through. I'll take this if there's a lot of momentum. If we just kind of consolidate slowly through this, through an old fair value gap that was respected, I don't trust it. Okay, and I'll show you an example in a little bit, or I think next slide. But if this was not a lot of momentum, I probably would not like it. And you can see another decent, this wasn't the fastest sweep here. I mean, this wasn't the fastest speed down, but you're going to see the speed up is just, this is a lot of momentum right here. It's just a single candle. It takes up all this. A really good candle there. This is what I'm talking about. So you can see we respect the fair value gap at first. We make our little internal high here, but we come back so much later, and price just doesn't want to go through it that fast. And these are the setups I don't really like to take. We have to speed back through the momentum if I want to take this inversion, okay? Because at this point, this is so old, and we already put in old internal highs inside this inversion. Okay, I know we did get a liquidity sweep here, okay, but we barely displaced back through it, meaning it's just not as good in my opinion, which is fine. I just won't take those setups unless I think that I will still sometimes take these setups. The bias is bullish, but yeah, so I just won't take these. And by the way, if you did take this, you would have gotten south of break even because you would have probably entered here. We hit the new internal high here. Okay, we make a new internal high, we hit it here, and then you would have instantly got south of break even if you did take it. So with my break even method, it would matter for you trade. Okay. And the other thing is I would have probably referred it to be an IFG on this leg. We tested it 1, 2, 3 times, and we just don't break it. So not really the highest probability, especially with the lack of momentum going back through. Okay. All right, so if there's no liquidity sweep, are we delivering from another fair value gap, lower time frame or higher time frame? Okay, and before I actually go to the slide, I want to show you an example of this again. I think I'm going to show an example on the live chart. So I'm going to go in the 5-minute time frame here, and I'll show you an example. So you can see right here, we respect this fair value gap here. Okay, the first time. We come back down, we get it. Sweep of an internal low right here. And you can see, look at the size of this candle going back through an old fair value gap we respected. This is what I like. Now, if we got like 3 candles and it took us 3 more candles to break this and we just kind of slowly broke it, I would not have liked it. But the fact that we get this major candle going back through it, which by the way, also forms a chain and state delivery here from what I taught you in the chain and state delivery video. Okay, also forms an OB/chain and state delivery here. This is the momentum you want to see to an old fair value gap. You can see this fair value gap's formed at 8:30, and by this time, it's just really getting old and older and older and older. And then we break back through it 2 hours later, an hour and a half later. But the key is here, we break through it again with so much momentum. Like there's a lot of momentum going up here. Okay, that's the important part. If this was not a lot of momentum, if this is not a single candle, I probably wouldn't have liked it. Okay. And the nice thing about this one is we close above this and also don't hit this internal high above, so it's much nicer of a setup, okay? So that's what I'm kind of talking about when I talk about an old inversion. Let me see if I find another example. Even this example, like this example, again, you're probably wondering, like, well, we sped back through this. However, the difference between this setup right here and this setup right here is they're the same setup, except in this one we did not hit that internal high first, so that's the nice thing. We had a very high internal high where the body respected, but we did not hit it. So this is better than taking this one, because this one we're inversing this and also taking a very obvious high at the same time. So not as good for this one. I would have liked this better if the candle closed like right here, let's say. So because I could have moved my stop to break even there. So that's kind of what I'm talking about with the momentum thing. I talk about this a lot on my live stream. Like I'll literally say I like this momentum or I don't like this momentum, especially if it's an older fair value gap that may have been respected in the past. I need to see a lot of momentum going back through it. All right, so if there's no liquidity sweep, are we delivering from another fair value gap? And I kind of already talked about this a little bit. I'm going to talk about it again. Okay, so again, sometimes you don't need a liquidity sweep if we're delivering from another fair value gap, right? And we know that because if we're delivering from a hourly fair value gap from internal liquidity to external, according to my MMXM videos, then we can take an inversion without a liquidity sweep, okay? And again, sometimes you will still have a liquidity sweep in a smaller time frame, but again, if we're delivering from a higher time frame fair value gap and we're in a market maker my model, you don't always need a liquidity sweep if we're the bodies are clearly respecting another fair value gap. Okay, so the best possible inversion for me is a sweep and a delivery from a fair value gap. Okay, this is the best inversion you can take. A single sweep is still fine. A single delivery from a fair value gap is still fine. I still take those setups all the time. But this is going to be your best possible inversion you're ever going to take. All right. You're going to realize that after experience. So this right here is a sweep and a delivery from a fair value gap. Okay. We're bouncing from a fair value gap and we're sweeping a low. And you can see this is not an old fair value gap, so we don't need a ton of momentum here, but you can see the momentum still here is still fine. We get about a 3 candle sweep here, which is fine. But you can see a sweep and a fair value gap delivery make the setup way better. And there's probably some sort of higher time frame high to the left here, which is why I would have taken profit there. But it's still good with either a sweep or a fair value gap delivery. But with both, it's just that's when it's the best. Okay. And you guys can see here's a bullet point. We're bouncing for fair value up to left, so it's a very good setup. This setup is still good with one of either, but these are definitely the best. So this one is the inversion relatively newer. Okay, if it's far away, like I said, I do not like it that much. There will be some that are far away. You're not going to be able to spot them unless you try to spot them. If you try to spot them, it's probably not a good one. If it automatically pops out to you, it's probably a good one. So if there's an inversion from days ago, I will use it more as a bias, not an entry. So when I'm looking at price and I'm on the hourly time frame and I see we inverse the fair value gap way to the left, let's say right here. So let's say we inverse this fair value gap way to the left right here. Okay, I'm not going to use this as an entry. This is just too far away. But I will use the fair value gap all the way to the left from a previous day for a bias. I'll be like, okay, we inverse this one to the left. I'll use it more for a bias. I'll look for some sort of confirmation entry up here, and then I'll look for that. But obviously, we don't get one here. But hopefully, you kind of get what I mean. If I go to the 5-minute chart, let's see if I can find an example. Let me see. So, like, too close. All right, so like right here, you can see price clearly respects this twice, which is very algorithmic, but we inverse it way later the next day. So I'm not going to use this for an entry, but I'll still use it for a bias. And maybe I do use it for an entry because I see a new bearish fair value gap form here. So maybe that's my confluence. But let's say this doesn't form. I'll use this for a bias, not really an entry if it's so far away. The only way... So I actually just went over this. The only way I will use old inversion as entries is if we get another inversion setup coming out of it, or even another setup in general coming out of it. So what I mean is literally exactly this. We inverse this on this candle. It's a high momentum candle, and it also forms a bearish fair value gap. So this is a setup where I wouldn't mind taking as an entry because it gives me a new entry while respecting this inversion, if that makes sense. All right. You have to be very careful with older inversions because some will just not be respected. Okay, I've seen so many just fail. You have to be very careful. I don't really use them a lot, but I will look at them sometimes. This is gonna be an experience thing. You can draw them, but I don't use them as much as I use the fresh ones that just form. Okay, if it's an older inversion, seeing us speed through them, like I said, is ideal. If we consolidate through them, it probably doesn't matter. And it's also common sense. Like if we get a new bullish fair value gap through an old bearish fair value gap, there's a more of a chance it works, right? So this one obviously works because we get a bearish fair value gap here versus this probably wouldn't have worked if we didn't get a bearish fair value gap here. I mean, maybe it would have, but it's not smart to enter because it wouldn't have been smart to enter because we don't have another bearish fair value gap coming through here, all right? So this inversion right here is 10 days apart. But when you see we go back above it, we go back above with a lot of momentum, and it also lines up with a new bullish fair value gap. So this would actually be semi-smart to use because it lines up with an old one. This is the hindsight, but then we form a new setup that lines up with this. Okay, if we don't form a new setup lining up with this, I would never use this because this is very hard to spot in my opinion. Okay, but you can still use it as a confluence. Another old one. This is much, I mean, this is a little easier to spot because you can see price reject at one time. But the reason why this is good is because, again, we get a high momentum candle going back through it with a new bullish fair value gap formed. Okay. And this lines up nicely. So we know this is probably going to be a better entry than if we were to just consolidate back through it with no fair value gap, acting like it didn't matter. The momentum back through it is acting like it matters because these are all the people still getting stopped out. All right. So it's probably going to, those same people are probably going to reverse their position. Here, again, what happens here? This is an old one from the previous day. And I'm not interested. Why? Because look, there's no momentum going through it, unlike the other one. So the other one had a lot of momentum going through it, but this one did not. So this one, even though it looks very obvious, which I would agree it's obvious, we barely have any momentum going through it. So, and even if I did want to look for an entry off of this, I would probably not enter blindly off this. I would probably go to like the lower time frame and look for like a 1 minute setup off this. I think this was actually an hourly or 15-minute, but I would go for a 1 minute setup and look for a confirmation setup here. And it's also, the close is during lunch, so not a great price action either, which is outside of the kill zone, as you guys know, which is not a great time to trade. Is the fair value gap a singular fair value gap? If it isn't, go to the higher time frame and see if you can turn it into a singular fair value gap, right? So I kind of went over this, but I have a little rules regarding this. So you always want to make sure the fair value gap is a singular fair value gap, not two next to each other. Okay. Remember what I said. If there's two next to each other and it doesn't form a singular one on like the 2 minute or 3 minute and you can't find a singular one, if there's two next to each other, make sure they're not gigantic ways apart. If they are, do not take the entry. And this is to ensure the RR, and then it's also making the setup much easier to spot, especially if you have to only use a singular one, because the stop loss is going to be and again, you want to do this to ensure the RR and the complication of the actual setup itself is just not complicated. Okay, it's better to use the inversion. It's going to be better RR. The singular inversion's going to be the better one. Okay. If there's two fair value gaps next to each other in the 1 minute, again, I will see if it combines into one fair value gap in the 2, 3, or 5. I don't really use the 4 a lot, just so you guys know, and use that. So, again, example here would be there's in this example, look, there's two fair value gaps here. There's this inversion and this inversion. Now, from a liquidity standpoint, I know that I don't have to wait for the 15-minute. I can take the 5-minute here because I know the bias is bullish here. So you don't have to wait for the 15-minute. But from an inversion standpoint, let's say you didn't know the bias, you would want to wait for the 15-minute inversion, which it ends up being invalid actually, because we actually, no, this isn't invalid actually. Okay, now, so this actually would have been valid because we close above without hitting the next internal high. And then you can see we kind of go down a little bit. Immediate rebalance. Okay, and then right back up again. Okay, so this one was valid. But I always say you have to understand inversions in terms of liquidity, because without that, you would never have taken this 5-minute. You should understand, like, yeah, we hit low day. We have our chain to say delivery here. You should understand this 5-minute still valid because you don't need to wait for the 15-minute if you see a signature bullish price in the 5-minute. Okay. If you're unsure of the bias, that's the only time that you would have to wait for the 15-minute. Okay. But in this example, let's say I didn't know the bias. We have a fair value gap here and a fair value gap here next to each other. So I'd have to go in the 15-minute and combine it into a singular one. All right. So if there is a 1, 2, 3-minute bearish fair value gap, and if they're all singular, sometimes it happens, I'll wait for the highest time frame one to break. So I'll wait for the 3-minute one. However, if I'm confident in the speed and the liquidity sweep or the bias, I will still take the 1-minute sweep or the 1-minute close if I'm confident in the bias. I will not wait for the 3. Okay, this will obviously take some screen time. and I'll show you an example in a second. But again, if you have no clue what the bias is, I will wait for all time frames. So basically, if you do know what the bias is, you can jump the gun and take the 1 or 2 or whatever and not wait for the 3. But if you don't know the bias, what I recommend is just wait for all the time frames to have the fair value gap in the same spot. Wait for all of them to close. So the 1, 2, and 3. Okay. That's going to be your highest probability, especially if you don't know the bias. Before I continue, today one of the losses I took was this. So we ended up, I thought the bias was bearish today, and I was right. So you can see I ended up being right. But it was NFP tomorrow, so you can just see terrible price action. And I was right. The bias was bearish, but I thought we were going to go hit the low here because we barely inversed this, but we did. And you can see we delivered out of this right here. So we delivered out of here. And I thought this was going to be a good short because we closed under. So I ended up getting stopped. However, if you look at the 2-minute, 2-minute never closed under its fair value gap. You can see the body's held. And this is why it was a loss. Now, again, I didn't need to wait for the 2-minute because I thought the bias was bearish anyway. So that's a risk I'm willing to take. All right. But hear me out. If you think you know the bias, you do not need to wait for the 2-minute. You can just take the 5 or the 2, whichever one inverses first, and the 5 ended up inversing first. But you should have probably waited for the 2-minute if you weren't sure what the bias was, right? All right, so here's a 1-minute that same setup. This is the 1-minute and this is the 2-minute. The liquidity sweep here was so fast that you could take the 1-minute here knowing that this is the one setup for life and not needing to wait for the 2-minute. Because if you waited for the 2-minute, you will not get the entry because we closed above and hit the internal high at the same time. Okay, see this? We close above, hit the internal high at the same time. So this is not valid because the candle closed way above the internal high, all right? You want to make sure you know the bias. And in this situation, I definitely would try the 1-minute and not wait for the 2-minute because it seems like the liquidity sweep is very fast here, and it seems like the bias is very easy here, okay? So this is an example where you don't have to wait, all right? In this example, again, this is an example where there's 2 fair value gaps next to each other. If this was not here, this would be much better risk reward because I always say I don't like the 2 fair value gaps next to each other because the RR is going to be worse. Because if we close above this fair value gap, okay, and you put your stop loss, let's say right here, okay, you could still get stopped out and we might still bounce from this one. That's the issue, okay? If you try to get an entry down here, well, what if we bounce off of this one? So it makes the setup way more complicated with 2. Okay, I don't like using 2 that much unless I know the bias, but typically I do not. So there's a lot of logic like, oh, what if we inverse this one, but then you put your stop here and we go here, blah, blah, blah. Or what if we inverse this one? Can you enter this one? Well, no, because what if we reject this one and then hit your stop here? Well, you're screwed. So ideally, you have to wait for both to break, but then the stop loss would be way worse. Okay, and the RR would be worse. So are we inside of a kill zone? So again, we must be inside of New York kill zone or London kill zone. I kind of explained this, but if AM price action is logical, meaning this right here is not logical. I'll show you. So this price action where we close under the fair value gap and then back above, that's not logical. Okay. See how I close under and then back above? That's not logical. So typically if I see, okay, AM price action is logical or good, I do not touch PM. But if AM section is bad or not logical, I will be more interested in lunch. Well, we don't get logical price action here. What happens in the afternoon? Awesome price action. Okay, you can see very nice price action. Very nice price action here. We get a nice long setup. Very nice price action here. Very clean inversion. Respects perfectly. You can just tell this is so logical because look, we wick all the way above this inversion fair value gap, but we never close above it. You can just see how algorithmic that is. And then we ended up sweeping sell side. So if the AM is not logical, I'll be more interested in the PM. Okay. More times than not, the AM is good, but once in a while it's not. Usually with news the next day. So what I mean by price being logical, I already kind of explained this, is just price close above / below an inversion and the body keeps respecting it. But if, as I explained here, in the 5-minute, if price closes below an IFEG and then back above, it's not logical. Now with ES, you get a lot more of this because ES is not as volatile. That's why I prefer inversions than NQ. But ES inversions are still fine. Win rate probably just drops about 5%. All right. Again, here is an example where this will not be logical. I know the bias, however, the candle would close above, and then close back below, and then close back above. That's just not logical because the way I trade, that would be stopped out. And typically, if an inversion works, all right, you want the body to respect here, okay? So it needs to respect both sides. So this is not logical price action. This is logical because you can see price closes above, the body respects it to the downside, and then we go and hit buy side. So that would be logical price action. This is what you want to see, okay? This is good price action. I'm guessing this price action, the news already came out, and there's no news ahead of time in the next few days. And then, are we delivering from a fair value gap, or are we delivering from the middle of nowhere? Okay. If we do not sweep liquidity, I always make sure we're delivering from somewhere meaningful. Okay. I always put more weight in the fair value gap. I know you can be like, oh, we're delivering off an OB, but it's not as weightful as a, I don't even know if that's a word. It's not as weightful as an OB. I need to see us delivering off an OB. So I usually put all the weight on that. And if I see us hit the highs or lows off on fair value gap way more, like again, I said if, but I meant I do see us. So I do see us hit the highs and lows off of fair value gap way more than delivering or bouncing off an order block. Okay, like we don't always have to go back to the. So look at this. So we don't even deliver off a fair value gap here. This is just the middle of nowhere. Okay, I mean we kind of do. It's there, but it's just not as great. It's not the greatest example, honestly. Trying to look for like an OB bounce or whatever. So see here. All right, let's say all right, right here. This is an example. So here we actually reject this OB. See this? We reject this OB. But do we ever hit the low? No. And that's just what I hate. Sometimes when you reject an OB, we don't go to the low all the time. Versus if we're rejecting or bouncing off a fair value gap, we usually go to the higher low. Not every time, but most of the time. More than an OB goes to a higher low. That's what I'm kind of meaning by that. So delivering from the middle of nowhere just means we're probably bouncing from a random spot there's not a fair value gap. I usually put the weight on a fair value gap only. And it's probably a PD array in some time frame, like the 15-second, whatever. I know I'm going to have smart Alex saying that. But if I'm looking to take a 1-minute inversion, I'm not going to base off delivering off of a 13.5-second time frame fair value gap. That just does not make sense. And it has to be obvious and it has to be on the 1, 5, or 15 because that's the time frame most people are going to use. All right. So again, right chart, I already went over this, but you can see we're delivering from this and the bodies are clearly respecting this. So this is a fine trade to take because even though we don't have a liquidity sweep, body's holding this. And I already kind of went over this same example, okay? But you can see 15-minute body holds the tick, and then we get a very nice singular inversion here. And I get there is 2 fair value gaps in the leg. However, this is still valid because if we don't hit the second one, if the second one and the first one are farther apart, all right, let me move this down. If the second and first one are farther apart here, what you can do is you can enter this one. And this one I would not mark it by because we're too close to this. So it'd almost guarantee be a break-even trade. I'd wait for the retracement here, and you can see you put in a new bullish fair value gap here, so you don't have to get in an inversion. You can enter the bullish fair value gap overlapping with it, which this would be a BPR. But again, there's two fair value gaps in the leg here. I would wait for this one to get inverse, and as long as we're not hitting this one, which this would be your internal or your scale spot, depending on if it's 10 points or not. As long as we don't hit this one, then go down, I will take this entry. And then when we hit this high, I will move south to break even. Okay, so that's the only time I'll ever enter with, like, if we have two fair value gaps in the leg, I'll enter the lower one if the higher one's farther apart. But if they're next to each other, like fair value gap here and fair value gap here, it's not worth it. Okay. Again, in this example, we're kind of delivering from the middle of nowhere. We swept some sort of internal high. We're not delivering from anywhere meaningful, though. And yeah, you just see we don't even go down to the low because, again, we're not, even though we swept this high, we got really close to this high and didn't sweep it. We're not delivering from a PD array here. We're not delivering from a fair value gap here. Again, I know we're not delivering from a PD array, but it's, by PD array, I mean mostly fair value gap. Again, I don't care for delivering from anywhere else. Pretty much, it's just the fair value gap I care about. So we do not take out the major high. We're not delivering from anywhere meaningful. I mean, there's going to be the people who be like, oh, but we're delivering from the CE of the wick. Okay, it's still not a fair value gap. So I would not count this inversion to work. Although maybe I would look for an inversion from it, or maybe I would look for a short setup from it on the lower time frame, but chances are we probably didn't get any here. But again, does not mean we have to go to the low if we do not deliver from somewhere meaningful. All right. Did we hit the internal high? And if we did, are you still confident in bias? All right. So this is one I don't do a lot, but there's times where if we hit the internal high, I'll still enter off like a CISD if there's a lot of speed or momentum, whatever. And again, there's times where I will not move my stop to break even for if we hit internal, if I'm really confident in the bias. Okay, sometimes I'll wait for us like kind of to blast up, and it's more of a feel thing. Okay, so this example, I'm going to go over this in a second. I'll go over this example, but this slide is important because many people think that this second play is my model. This is not my model. We already hit the internal high. The model already played out here. I get DMs all day being like, oh, this is your model. This worked really nicely. This is not my model. This is your model. However, if you're confident we're going to hit this high, then can you long this? Sure, be my guest. But you got to realize it has a much lower win rate because we already hit the internal high. All right. And you're DMing me here. I'm already out of the trade here probably. So you can get away with taking this play, but you just have to be very confident bias. If we hit the internal high, then come back down, like I said, it's going to have a much lower win rate, okay? So you got to understand that. So this play, you can see we close above the inversion. I would buy in the market buy because this risk reward is still good. And we do hit the internal high, so typically I'd move my stop to break even. However, this sell side sweep was so fast where I would still be pretty confident this is still going to work. So I would probably wait for more of a blast up to move my stop to break even on one like this. And just again, the play still looks good here, even though we hit this internal kind of fall here a little bit. Like, I remember we were so low. Okay, we were so low at this point, and I just knew this would probably work for long still. So I kind of waited for like us to kind of blast over this internal rather than wick over it, then go down, because that's like, okay, now if we go down after this candle, I'm probably gonna get stopped, and that's kind of a feel thing. And again, I wouldn't regret getting stopped for a loss here. I always ask people, would you regret getting stopped for a loss? And in this situation, I probably wouldn't because I know the bias is nice here. So that's going to be it for the checklist. I'm going to end this. This is going to be the end of part 2 here. A lot of information. I know this is going to hopefully change your life because this is just an insane setup, but that's it for part 2. Your assignment for this video, now that I showed you all these examples and all these checklists, is find 5 inversion setups on the 5-minute time frame or less. Remember, I don't enter inversions in the 15-minute or higher, mainly the 5 or 1. Find 5-minute or 1-minute inversions in a journal, and find 3 confluences for them working. And those 3 confluences should be all having to do with this checklist, okay? So is there there's a fast liquidity sweep. There's equal highs above or inside of a kill zone, whatever. Okay, so find 5. That's your assignment for this video.